It's time to turn our attention to the cash conversion cycle, which is a very simple idea within corporate finance or the corporate issuers section of your curriculum. I think it's best illustrated always with a timeline. Within the so-called operating cycle of a company, operating cycle being the time needed for the business to purchase inventory, then inventory is held. Sometimes it is being transformed into some finished product, and then a sale is made to customers, and ultimately customers pay money for the product. Well, in this video, we're more concerned with how cash flows out from the company and into the company in connection with the buying and selling of inventory items. So on the timeline, I'm going to mark a point here on the left-hand side and assume this is the moment when the company buys the inventory from suppliers. So by the decision to buy inventory from our suppliers. Now, buying the inventory from suppliers doesn't necessarily mean that we immediately pay for that inventory. Typically, an established business will buy on trade credit, so be able to defer payment until some later date. Nevertheless, from this moment on, the inventory will already be present in the company's assets under inventory. Okay, let's assume that over here we actually pay our suppliers or our supplier, right? And let's assume that over here we sell the inventory to customers or a customer. However, once again, the customer doesn't necessarily pay immediately. We receive payment from the customer, obviously the same customer who bought here sometime later from our customers or customer. Good. Right. When we think about how cash flows through the business, we operate we will be measuring, or you'll be required to measure the cash conversion cycle. And let me try and illustrate what that actually is. First of all, from the moment you buy the inventory into the business, all the way until you sell that item, let's assume this is a simple business which doesn't convert the inventory into some transformed finished product. We just trade inventory items, so we sell them without doing any transformation. That period here, starting on the left-hand side with the purchase of the inventory and the sale of the inventory to the client, is how long the inventory kind of sits in the warehouse or sits in our balance sheet within the inventory line. And this length of time is in your curriculum, denoted as DOH. This is short for days of inventory on hand. Okay. Now, over here we've got another time period. This is the time between the sale to the customer, when typically the customer takes the goods, takes over the control over the goods which they purchased. They receive an invoice and ultimately settle that invoice at some later date. And from a balance sheet perspective, the amount of money for which we're waiting for here will be shown under accounts receivable. Also within assets, accounts receivable result from sales already made, where an invoice typically has been issued and we're waiting for the client to pay us. So this period of time, it's going to be measured in days, is abbreviated as DSO. This is days sales outstanding. Now, in this section of the curriculum, you're not required to compute the actual number of days. You're just supposed to appreciate this is a period over which the company is waiting for payment from a client. And in theory, you could compute the entire length of time by adding the two components between the purchase of inventory and ultimate receipt of money from a client and say, well, it's for that entire period which the company needs sort of temporary interim funding, but that would ignore the fact that we typically purchase from suppliers and actually pay the suppliers at some other date, a later date. So over here we will have another, let's say, period of time, this one called DPO, which stands for Days Payable Outstanding, and this measures the average amount of time between the purchase of supplies, inventory items from our suppliers, and when we actually settle with our suppliers. And in fact, we in business are primarily concerned about the length of time between when we have to pay our suppliers, which is over here, and when we receive money from customers, because the company will need to have funding for that gap, and that gap is known as the cash conversion cycle. It's measured in days. It's expressed in days, and formally speaking, the way to compute this would be to say, well, it's DOH plus DSO, but critically minus DPO, the amount of time it takes you to settle with your suppliers. So this becomes the length of time between when we make the cash investment in inventory, when we already hand the money over to our suppliers, versus when we receive money from customers, cash receipt from customers, from the inventory sale. Now, your book, as I said, contains some examples of this computation, but nowhere in this section in corporate issuers are you actually required to compute the DPO, DSO, or DOH numbers. That is required elsewhere. Now, the ideal situation would be to make this CCC, the cash conversion cycle, short, or better still, even negative. And a negative conversion cycle is sometimes present, especially in big supermarket chains, where they, buy inventory from suppliers and have a very long time until they need to pay those suppliers. And typically the goods rotate pretty quickly in the sense of not lying too long or sitting too long on the shelves in the supermarket. And when customers pay, the supermarket receives money pretty quickly, because you typically pay either by pay in cash or by card, where settlement of that card payment happens within a matter of a couple of days. And sometimes the supermarket has, a lot of the time, supermarket chains have already received money from the sale, even though they haven't yet paid the supplier for those items on the that were sold, and that means they've got a negative cash conversion cycle, which is an extra source of funding for them. They don't need to borrow money from financial institutions, at least not to fund this working capital. Okay. You need to be able to recognize ways to shorten the cash conversion cycle. So ways to shorten the CCC, the cash conversion cycle. And ultimately, if you want to make this cash conversion cycle smaller, you can reduce DOH, you can reduce DSO, shrink it, or increase DPO. Because it enters here as something negative. So all of these are absolutely acceptable, and let's just think about this. How do you reduce DOH, days of inventory on hand? Well, some ideas, as suggested in your book: reduce the holding of low demand or niche items, right? Reduce your holding of stuff that doesn't sell very quickly because there's a low demand for it. It's very niche. The longer you hold it on the shelf, the more sort of you need to lock money up into it. Hold stuff that rotates a lot quicker or turns around, turns over more quicker. Get more frequent supplies from your suppliers. Instead of ordering huge amounts, which then means you've got money frozen up in inventory that sits there for a longer period of time. And so this is associated with systems like just in time. And another idea is maybe try to improve your customer demand forecasts, improve the quality of those customer demand forecasts. Okay, that's another avenue suggested by the curriculum. Right, what about reducing the amount of time, the period over which you're waiting for your customers to settle with you? So reducing DSO, days sales outstanding. Here, encourage timely payment from your customers, encourage prompt payment. And one way to do this is to, offer them discounts, offer your clients discounts for paying quicker than even the term on the invoice. And we'll be thinking about the effective cost of using such discounts in just a moment, because there's a little computation you need to be able to do. But also discourage them from paying late by introducing sort of late payment fees. So a form of penalty for being late in the payment. Tighten credit standards is another idea, i.e. Select to sell on credit to customers who are of a good quality, and therefore there is less likelihood that their payments will come late, and perhaps use the services of third-party collection agencies who specialize in getting money back from clients, or enforcing payment terms, although that may not be necessarily a move that will win you friends from a relationship point of view. So you have to be careful here. And okay, the final piece of this puzzle was DPO, days payable outstanding, and we could try to increase this. That is lengthen the period over which it takes us to pay our suppliers. And here the suggestion is, don't be late. Necessarily, we wouldn't advise that, but negotiate longer term contracts with suppliers. However, that typically, if you want to negotiate better terms, that is longer payment periods, you'll typically need to order higher volumes, which kind of goes against not holding too much inventory. We mentioned, increase the frequency of supplies rather than reduce it. And of course, the ability to negotiate better terms does depend on the relative power of us, the buyer, versus our suppliers. If there are multiple suppliers supplying the same thing, the relative power of a single supplier is relatively weak. But if there's just one supplier, one producer, then you really probably don't have much chance of negotiating anything too attractive. Now, one thing that you may need to compute, may be asked to compute, is the EAR. That's the effective annual rate of supplier financing. And the context will always be, for this computation, very simple, although the computation itself isn't that sort of user-friendly. Let's say you've got a supplier with a normal payment term of 30 days. 30 days is typically used as kind of the standard, or something like 10, 60 or 90 they may give you, right? Something like this. But let's assume that this supplier also offers a 3% discount for payment within 10 days. So if you pay much quicker, 10 days, instead of the normal 30, you get a 3% discount from the normal price. Now, you may, with this data, be required to compute the effective annual rate of supplier financing, which is basically all about determining whether it makes sense to take advantage of that discount or actually forego it. Well, the clue to solving this, although it will not necessarily help you with the formula because the formula is a bit ugly, is to consider that not taking advantage of the discount, is effectively equal to borrowing money from the supplier for, in this case, 20 days, right? 20 days. Well, I got 20 days from the difference between the 30 and the 10. So when I say borrowing, I mean letting the supplier fund you for an extra 20 days. And we're now going to try and compute the effective cost of this. So the EAR of the funding supplied by our supplier, the financing provided by the supplier, is computed as, and this is a terrible formula, 1 plus the discount, as expressed in percent, divided by 100% minus that discount, raised to the power of days in the year, divided by normal payment period, which in our case would be the 30 days minus the discount period. So as you can see, what we will get in the denominator of the fraction is the difference between 30 and 10, which will give 20, because this is effectively how long we're getting the financing for. So over here we'll have 20 days, over here we'll have the number of days in the year, so this is like extrapolating to a full year. This would be typically 365 days, everything minus 1. Plugging in the numbers now properly, we would have 1 plus the discount is 3%, divided by 100% minus that same 3. So hopefully, that's not so difficult to kind of remember. And now you raise to the power of 365 over 20, like we said, but 20 is the fact that you're allowing, by not paying after 10 days, you're getting some funding from the supplier, but you have to pay for it. You pay for the extra 20 days of funding, of not having to pay, by foregoing the discount, by not taking advantage of the discount. So what do we get? Well, we still have to deduct 1 over here. Now, I'm not going to show you my calculator. I'll just, do the computation on the calculator. So I've got 1 plus 3. This should be 100, minus the 3. So 3 divided by 97, the fact that it's in percent doesn't really matter, raised to the power of, open bracket, 365 divided by 20, close bracket, and made a mistake here. 1 plus 3 divided by 97, okay, raised to the power of 365 divided by 20, close bracket, equals, okay, and now deduct 1, perfect. Now I'm looking at an answer of 0.743 something, which basically means 74.3%. And don't kind of think I've done something wrong, because it's rare to find values as high as this, percentage values as high as this. This number will typically be quite big. Your curriculum uses a very similar example, but the discount there is 2% instead of 3, but it still gives a number of 40-something percent, right? So how do we interpret this? Foregoing, that is, not using the discount, and instead using the supply of financing for those extra 20 days beyond what you would get anyway, the 10 days you would get, is very expensive. Given what you lose, expensive. Given what you give up or lose, the discount of 3%, this extra 20 days, when we annualize it, it costs you 74.3%. And what you may also be given is the rate at which you can borrow from the bank. And it will typically, for a company, it will not be as high as 74.3%. This is obviously per year, per annum. And therefore, it probably makes much more sense to borrow at a lower rate from the bank, pay the invoice after 10 days to get the 3% discount, as opposed to waiting to pay it after 30 days and giving up that discount. This is the proper way to do it, although I recognize that the formula isn't necessarily very intuitive. Now, a final note here on the cash conversion cycle relates to working capital, and two ways to compute working capital. We often make use of working capital in finance. We talk about it in various places. So your book sort of goes and says there are two ways of doing this. One, there is something called total working capital, which is simply current assets from the balance sheet minus current liabilities. And that, of course, is a relatively simple computation. And then there is something called net working capital. Capital as well, where the whole framework is also based on a comparison of current assets, minus, so less current liabilities, but we make certain adjustments to both figures. So it's not just current assets taken directly from the balance sheet and current liabilities. There are certain exclusions. So current assets would excluding cash and marketable securities. This didn't come out right. Marketable securities. And within current liabilities, we also make some exclusions. So this is excluding short-term debt or current debt. Why do we make these exclusions? Well, the idea is that these items in brackets here, both up here and down here, with which we adjusted current assets and current liabilities respectively, these are items which are sort of less related to the company's business operations. I mean, holding marketable securities or short-term debt is less to do with the cash conversion cycle. It's business operations, or it's less directly related to it. So we just want to focus on those assets and those liabilities which truly relate how the company does perform its operations, how efficiently it does so. And one more thing, in order to be able, so as to enable comparisons either, in the time series, so across time for the same business, or cross-sectionally for different businesses which may operate on a completely different scale and may therefore have different levels of working capital as such. It may be a good idea to relate this working capital measure to sales, net revenue, for for common size comparability, so to speak.